Hi guys. Hi ladies and gents. Um, yes, beach. We all allowed to go to the beach. No rivers, no ponds, but beach. I'll play my part and go next week. We shouldn't. It's incredible that we all live on an island, so it's natural for us to want to go to the beach. So yes, it was some real separation to not be able to go to the beach. How was the weekend for everyone? Quiet. Alexis, are you did Insta as well? Because I put out Insta grades on Friday night actually. I put out Insta grades. Is Jahil in the mix this morning? All right, so let's go team. We're going to be we have one more lecture to do and then we're done. And we are finished with all of our course material for farm admin. And we will start from next week. We should start reviewing all of the courses that we did in preparation for your second in-course assignment and your final exam. I spoke to Dr. Maraj yesterday, and um, most likely you all are going to be getting your lit review to be completed to be completed to be done next week, which will be the second November 2nd, and your second exam should be on the 16th of November. So finals should be the first or second week of December. So I want to have enough time to correct both your lit review and your second assignment, so everyone, all the students can have the benefit of their coursework grades as they move into the final exam. There was a suggestion made by a student to take attendance on the roll call. Should I do that? Because attendance and participation is also 5%. Should it be given away free to everyone because the circumstances aren't all that great? What do you all think? Should I give it away free, or should I do the roll call? Samantha C. What's so funny? The roll call. All right. So I'm seeing 17 students online right now. Um, Kar- Karishma San, can be generous. So tell me something. How about I get some feedback from you all with respect to your first exam? Anybody wants to say anything? Um, did they find it was very tough, very difficult? And I'll give you my responses to that. Some people might have internet issues. Yes, Samantha, see, okay, I understand that. Internet issues, electricity issues. I know there was a lot of power outages within recent times. Um, I know people have responsibilities, and yes, although this is supposed to be scheduled time, I know people have kids, people may have work responsibilities, people may have duties with their parents at home, but we have to appreciate that having classes online, that it does bring with it a whole lot of convenience as well. So we have to be balanced. We don't want to be given opportunities, waste them, take them for granted, etc. So tell me, what did you all think of your first exam? For those of you who are in community and INSTI, I'll take all the comments, good and bad, and perhaps I can explain myself so you can better understand. Nobody? Well, what I can say is for this course, Farm Admin, feedback in terms of your marking, how was it? How was that marked? Well, remember these are all essay questions, right? And how we go about marking this is there will be certain keywords or key phrases or key explanations that we'll be looking for. And you have to use the last part about key explanation because some of you give me a really hard time in having to read through all of this just so that I can see this. But that's essentially how we mark the essay questions because remember, if we want, how do you expect a heavily researched answer for the question? Do you expect? So, Kavita P, what I expect for the answer is this. I expect you to be, first of all, using material from your lectures and from this interaction, from my teaching, that is the basis of perhaps more research on the issue because I would be aware of more information more than what we are able to teach here. So I would expect it to start here. What I'm seeing with a lot of a fair amount of students are that they give me papers that are sometimes there's absolutely no material from your PowerPoints. There's no material from me. And I have to now look through to ensure that at least what you researched and what you are writing does contain the elements and the substance that we taught in the lecture. Kavita P, does that answer your question? So it's a golden rule for all students that I would always say yes, that if you always go and pay attention to your teacher. I mean, I know I would have been guilty of not doing that in my younger years, but I really saw the benefit of it in my undergrad, and my postgrad work as well. Paying attention to your lecturer is important because your lecturer is the one who's going to be setting your exam, who will be correcting your exam. Even if it's a foreign university doing the setting and the correcting, the lecturer would still be the one giving a proper guidance based on what they know the exams are going to be like. Now, all of this is not all of this teaching, no matter if it's pharmacology or our management courses, these are not meant only for you to pass exams. And again, I want to big up Shakila and Precious for doing a wonderful job in their first in-course assignment. It was, again, a real pleasure to read, and I was very happy with it. I'm only mentioning those two names because they were the highest marks, right? But they were persons very close to her, to they as well, that did okay too. And um, a senior moment there. Right. The purpose of these courses are to develop and train you. And at the end of your program, let's just say you may have been barely passing coming along, or your grades are not all that great. That's fine. At the end of your program is where you are expected to now have the elements of all the elements of the different courses that were taught. And remember, this is a practice. Pharmacy is a practice. Management is a practice. So you know how to be able to apply the things that you teach in everyday life, in everyday world. The same way for all your science-based courses, you have to now make a clinical application. You have to make a clinical application. You have to make a clinical decision. Similarly, in management, you would have to now look at the theories and look at the approaches that we discuss in these management courses and apply it to your real life experiences, your real life work. So I'm saying that because I want you all to understand that yes, good grades are excellent, but it does not mean that you would have gotten low grades. It means that you're now going to be a bad manager. It just simply means that you are learning throughout. You are learning throughout. And by the way, I try my best not to fail anyone. I don't think anyone failed. Well, I'm not sure, but I think maybe one person. But I'm trying my best to not fail anyone. Although in some of the exams that I've been correcting, it has posed a real challenge when looking at the material and not seeing any elements at all. It makes the work difficult in correcting. So, guys and ladies, I'm reminding you all, start off with your PowerPoint lectures, follow it up with the sessions we have here, and of course, do your reading, do your research, quote your research properly, so that you can give nice, cogent answers. Nice, cogent answers. Answers that say to me, I understand the material and I'm actually a little expert on the material as well. All right. So let's get into the review for. Okay, any more questions for me before we start the review for last week? Last week we did inventory management, and I know Jahil said it seemed a bit confusing, and I expect that some of the students would find it confusing. I mean, even I myself, when I was first introduced to these type of things, it was still tough to fully comprehend. But just bear in mind that as managers, you will not be expected to do the detailed components of these things, such as inventory, the inventory analysis, and the ratios that we can do today, and the financial statements that we did 2 weeks ago. You, as the manager, the reason for us doing these parts of the course is so that when you are presented with the information, you are not completely lost. That's the purpose of it, so that you will have some information that you can now make sense of the data that might be presented to you as a manager. All right. Okay, so let's go. We did inventories last week, and we defined things such as a purchase order, receiving report, um, and how things are received in terms of matching what was ordered to what is actually received and then entered onto your inventory system. We know that nowadays there are fancy inventory systems, point of sale systems that also record inventory. I mentioned to you how doing a stock count uh, at least once per year is important so that you can correctly record your inventory, so that you can also identify something that starts with S. By doing a stock count, we can identify or take a look at or something that starts with S with respect to inventory. What is that? What is that we'll be looking for? And don't use no bad words here. What is that S word we're looking for in inventory when we do stock counts? Supply, no be cash, not supply. Come again. Well, and this is with respect to a stock count. When we do a stock count, we are looking out for, we also, pay attention to this S word. Anybody else want to make a try? Samantha C, Alexis, I'll call out the names I've seen here. You all know Karishma, Kavita P, the S word. What's the S word? You all shy this morning? Shrink. Yes, Samantha C, shrink. We're looking at shrink. And please remind everyone what shrink means. Would anybody want to put forward what shrink is? What shrink is with respect to inventory? Come on, Google sticking. Come on, Google sticking this morning. What's going on? Loss of inventory that can be attributed to factors such as employee theft, shoplifting, administrative. Samantha, see that looks like a real copy and paste there. Is it? Is it? Yes, but yes. Loss of, right, Kavita R, loss of inventory, Google. The wonderful thing called Google. Which class was it we did this? I think it was in community management. Right, okay. So yes. So shrinkage is loss of inventory that can be either theft, or it can be in another location, or administrative error, vendor fraud, etc. Good. So good. You'll understand and appreciate what theft is. And then we look at the inventory cost flow assumption. And the cost flow simply cost flow, how much where how your cost is flowing in your organization with respect to the inventory. And we looked at the first in, first out, which resembles the actual rotation of stock, the commonly used rotation of stock, which is I buy an item on Monday, I buy several items on Monday, that's on the shelf. As it's being sold, I may buy some items on Friday, the same item, and when I buy that item, naturally, I would put it to the back of the first set that was bought. So that's stock rotation. Everybody can understand that. Those of you who may have a little small retail experience, whether it be a grocery, pharmacy, etc., you know about stock rotation, right? And I remember Shakila said that she remembered she had familiarity with that. And similarly, it wouldn't matter if the same price that you bought I bought the items on Monday is the same price of the items that I bought on Friday. It wouldn't matter, right? You can put them anywhere. Perhaps what would matter is the expiry dates. But in terms of costing, sometimes the price that we pay for the item on Monday would be a different price to the item that I bought on Friday. And we know from being in practice, in retail practice, that at times when price increases occur, they increase the very next day. They would tell you in advance that prices are going to go up for this item on the 6th of June. So if you bought items on the 5th of June, you are paying $5 for the item. If you now buy items on the 10th of June, you are now paying $7 for the item. So this is where the inventory cost flow assumptions and methods are done to now look at the costing of your inventory and how that costing is reported in your financial statements. All right. So if we buy the item for $7 on Friday and we put that item to the front, then the $7 item is going to get sold first, right? So that's where you have now the last in, first out cost flow method, where the last units, usually purchased at a higher price, are sold and the ending inventory is made up of the first purchases. So it all has to do with the two things that we are looking at here that affects your financial statements would be your ending inventory, your cost of goods sold. Your cost of goods sold is important in determining your net income. If you remember from your financial statements, your net income is your revenues, all of your revenues. You have to subtract from that revenue all of your expenses, and part of your expenses is your cost of goods sold. So if your cost of goods sold can be altered based on whether you record the inventory being sold uh, using LIFO or FIFO, it can now alter the cost of goods sold. And by altering that, you are now going to alter your net income. So this is the relationship that I want you to appreciate with respect to inventory costing methods. All right. And then the weighted average inventory costing method is the total amount of units that you bought and the total amount of money you paid for all of them, and you do an average. So that's as simple as you can get. All right. Um, all right, and you can see here in slide number 6, for tax purposes, LIFO is now widely used even when it does not represent the physical flow of units. All right, so using the LIFO method, ladies and gents, is an accounting method that all organizations use in order to ensure that they are not overpaying on taxes. Right? And essentially, it alters and it adjusts your um, income statements for determining of your net profit. Then we had some examples here that you know might be look a little confusing. So let's look at on slide number 9. And this one, if you can take a paper or something and just block off the bottom two squares and block up the arrows as well. You just look at the first one on top. As I just said just now, you buy the item on this date for this amount of money, and then you buy some of the same items at another date for a little more money, and then you buy it a third time for even more money. And based on first in, first out, you are now selling out all of the ones that you bought initially, and then you are selling out some of that which you bought the second time around. You may have some remaining from that second purchase, and then all of your third purchases, together with the balance of the second rounds of purchasing, remains your ending inventory. And I remember explaining to you that they use the word merchandise inventory here, but it's just ending inventory. They use the phrase cost of merchandise sold is cost of goods sold, same thing. And when you compare it to the last in, first out, you see that how much all of the inventory that you bought at the most recent time, all of that is sold. And then all of the inventory that you bought at the second occasion, all of that is sold. And then the ones that were initially bought, some of it was sold, and some of that one is now recorded as your ending inventory. So if you bought items that the prices increased and you use last in first out method, you would have now a high cost of goods sold and a low ending inventory. It makes sense. It's easy, simple maths. If you bought an item that cost one and a half times how much you paid for it a month ago, and you're assuming that that was the one that was sold out, then clearly the cost of the goods sold will be high, right? And the weighted average, as I said, is just the total cost of units over the total number of units that were available for sale. And there is a slide that compares the. So there was a slide that was comparing all the different values, but that's okay. So on slide number 13, you're going to see what we're looking at. By using either FIFO, LIFO, or weighted average, you will get different amounts for cost of goods sold, gross profit, net income, and ending merchandise inventory. And these are the four things that now affect your income statement, affect your balance sheet, and are now used by the accountants for generating financials for tax purposes or financials for um, bank purposes. All right. And we also looked at something called lower cost of market. The lower cost of market is when you buy an item today and you pay $5 for the item today, but on Friday you want to buy some more of the items and they actually cost lower. The price is lower, so you have a calculation for net realizable value, which is the estimated selling price and minus the cost of direct disposals. All right, so that's the review for inventory management, and I hope that the take-home points are as clear as can be, where we are looking at the manipulation of those four parameters that are used in generating your net income statement, your income statement, sorry, and your financials. Okay. All right. So, any questions before we move on to ratios? Any questions, any queries, ladies and gents? And I notice the second week in a row, my students from Farm have been not talking to me much. I don't know why. Hi, Shakila. Okay. All right. So let's get into this ratios. Now I have actually some more. I did this last time by sending it to you on via WhatsApp. Maybe it's from how do there was some for some different formula to help you better understand the ratios lecture. How did I do this? Wait, just give me a minute, right? How did I do this? Send me um can someone send me their email? Actually I supposed to have all of your emails. I could attach these here for helping. Shakila, I'm sending this to you, so can you please forward it to your colleagues? Shakila, I'm sending it to your email, right? Just forward these things to your colleagues, please. It's just additional information to help better understand the ratios lecture. Now, again, I want to emphasize to everyone that these lectures are meant to help you to introduce you to these things and to help you understand if it is you are presented with such information to analyze, etc. But you generally as management, you would not be required to produce these ratios or to get the data needed to get to produce these ratios. These things are done by your financial analysts and your accountants. All right, Shakila, I sent it to you. Please do me a favor and forward it to all of your classmates if you can. Shakila, you got through? I'm assuming you got through, right? Okay, so But I'm not able to open it up on WhatsApp, so I don't know if you guys are able to open it up. Yeah, I can't open it either, Shakila. So I don't know if you could just send it via email, if you have everyone's email address. So whoever would have everyone's email address, it's opening on WhatsApp web. Okay, something I don't have. I think I did this last in summer, the type of file it is. Because in summer, I think I did it, and I think it was through WhatsApp it was sent, and everyone got it in it. All right, well, tell me when you're ready first, so we could just start the lecture, and then we'll go for the break. Right. So you're actually getting it open. Right. So that's those things that I sent are just extra information to help you better understand this whole ratios thing. All right. So let's just start some, and then we'll go for the break, and then come back and complete the ratios lecture. And we could perhaps start some reviews today of all the lectures we did. All right. So financial ratio analysis is something that, again, your financial team, your accounting team is going to develop these ratios that would take information from your balance sheet and your income statement and other financial statements to now give you ratios that are used to compare to industry standards. That tells information about the company's ability to be profitable, its liquidity and its safety, whether the company is moving towards being solvent, or how much risk the company has. Um, they use this regularly and most times when companies are in the process of looking to purchase, or there are mergers happening between organizations. So it's a financial analysis that focuses on the three issues: profitability, liquidity, and safety. Um, it takes information, as I said, from your balance sheet and your income statement. And if you take a look at your income statement, there you would see your depreciation expense that we spoke about. You would see your net income that we spoke about, how depreciation affects your net income. You'd see your cost of goods sold, and this is what we just spoke about in inventory management. Those numbers are what are used at times to, um, adjust and alter your income statement accordingly. So your working capital ratio, your working capital. This is essentially uh, something that compares the current assets that you have with your current liabilities. And again, reminding everyone, current means that which current assets are receivables and inventory and all of those things that can be converted to cash within a year, within the financial year. And current liabilities is that which is owed by the organization within the current year. So year one, you're in a hole of 35,000, and by year two, you're in a positive of 20,000. And these are very normal experiences for new organizations or even old organizations. So you'll see some organizations at times would post, they made a loss this year. Let's just say you might read in the newspapers that Scotiabank posted, not, sorry, not Scotiabank, not any of the banks in Trinidad and Tobago. Um, Angostura. Angostura would at times say that they would have posted a $300 million loss. And then at the end of the year, or at the next year's financial statement, you would see that they posted a $200 million profit. So these things are normal. These things are normal in organizations as they go about managing their affairs, and when they have reported financials that are bad, that needs addressing, your executive team, your C-suite, they would look at the financial data. They would be asking the accounting team and their financial team for information on where they may have spent their monies bad, where they may have invested bad, um, and work towards getting some of these things off their financial statement. You would hear managers and executives talk about removing some things from their balance sheet, removing some items from their income statements and their cash flow statements. These things are all within generally accepted accounting principles to have adjusted and fixed. Well, of course, you need to take action as well to get these things removed from your statement, because you can't just suddenly remove a long-term loan payment. There must be an explanation in your financials as to why that loan is no longer there, and it must be reflected in the numbers. So your working capital is your current assets minus your current liabilities, and your ratio to that is called your current ratio. And your current ratio, the industry average, is 1.5. And you can see from year one to year two where it compares your assets and your liabilities. You want your assets to always be actually equal to or more than your liabilities. So that's your working capital ratio. And that tells you the ability to meet short-term obligations, right? Your ability to pay off your debts, or to pay off your debts within the financial year that you are operating in. And the next ratio that we have here is your asset test ratio. It's also called your quick ratio. I think this is supposed to be the set of files that I gave you. Your quick ratio. And your quick ratio looks at all of your, but it kind of, you can say it breaks down in a little more detail what your assets are. So it looks at your cash equivalents, it looks at your market securities, your net receivables, and then that's now compared to your current liabilities. Industry average, as you can see here, is zero point 0.8. All right. So if your asset ratio is lower than zero point 0.8, as you see here in bold, it would mean that you may have some trouble meeting your short-term needs, and it compares closely with your working capital ratio. And your cash ratio is your cash equivalents and your marketable securities. You're not including your net receivables here, and that's still compared to your current liabilities. So it's this one is would be directly related to how much cash you have available for meeting your needs and covering your expenses. So let's go for the break now. When we come back, we're going to look at the other types of ratios. It's not a long presentation, and as I said, these things, we're just introducing these terms to you all, um, so that you can have an appreciation of these things. All right, so let's go for the break now. When we return we'll come back at 10:05.